a second, let's pretend this is you. A young, decently attractive, and for the most part, happy-go-lucky kind of person. Okay, so life is going pretty decently, but maybe you want a little bit more out of life. Chances are you want to get right here, but you just don't know how. Let's be honest, stuffing all those loads of cash underneath your mattress isn't really getting you where you want to be. Maybe you're the kind of person who likes taking risks, but you're a little scared about putting your money into something you don't know about. Investing actually doesn't have to be all that risky if you choose to play it safe and you just know a few tips. So really, here's one of the big secrets. The key to safe investing is diversifying. So what does it mean to diversify? It just simply means spreading your money around into different places. It's like that old saying about not putting all your eggs in one basket. If the basket falls, then you end up with just a bunch of cracked eggs. And we all know that's not good for anything other than making omelets. But if you diversify, then you minimize the risk of putting all these eggs in one basket. Okay, don't get ahead of yourself now. Don't think that diversification is going to mean that you're going to be loaded with cash. The key is asset allocation. All right, what does that mean? That basically means just choosing the right mix. Okay, so let's take for example one type of fund. It's called a mutual fund. It's run by investment companies that pull together money from lots of people and decide for them how to invest it. It's like having your own personal broker. Okay, I think you're starting to get the concepts. Before you start, you need to make some decisions. First, you need to decide what types of mutual funds to invest in. There are funds for different types of securities, including money market accounts, bonds, and stocks. Money market funds are considered prudent bets, but bond funds are pretty good too. But most people invest in stock funds, which obviously invest in the stock market, but they vary quite a bit. So those are some pretty good options, but maybe you're worried about having some person out there who you really don't know investing all your money into these different types of funds. Luckily, there's another option for faithless people like yourself. It's called an index fund. Index funds are managed not by people but by computers. For example, one index fund invests in the 500 largest US companies. Not only is that simple enough for a computer to do, it's also extremely smart investment in the long run. One of the great things about these index funds is they tend to have lower fees, so that means you get to save some cash. The reason for this is that the computers do just fine without holiday bonuses or going home to see their wife and kids at night. And turns out they tend to do just as well as other types of mutual funds in the long run. I know you're pretty excited, and truth is, you probably should be. You're learning something that's going to be really important and really valuable in the long run. But that's the key word here, long run. Most of these funds take 5 to 10 years to mature. But these are the types of investments that smart people tend to make. And anyways, you're going to be making a lot more money than you would be stuffing your cash underneath your mattress. Okay, so now that you've decided to go for mutual funds, actually the rest of your decisions are pretty easy. 1, you need to decide who you want to invest with, and 2, how much money you want to invest. Okay, maybe you're feeling a little bit of decision-making fatigue already, and maybe you're ready just to type mutual fund company into Google and hit I'm feeling lucky. But if you want to weigh your options, click on this link for a list of the 50 largest mutual fund companies. Okay, let's take for example the T&H group. Let's see how we'd get set up with them. Right here on the main page is a list of the different types of investments that T&H offers. Go ahead and click on mutual funds. So if you've been paying any attention the last few minutes, you'll likely choose index funds. There's lots of fun reading material here, but if you're looking to cut corners, just take a look at the 10-year average annual returns. That'll give you a good grasp of how you're expected to do in the long run. Okay, so after you've selected your fund, just click on buy. You'll need to set up an account and then designate how much money you want to invest. Notice that this particular investment has a $3,000 minimum. You can choose to invest the minimum or as much as you want. The money can be transferred straight from your bank account or you can pay by check. Okay, so now you've got your investment. Now what? You may be tempted, like many people are, to check the investment daily, but don't. Honestly, day-to-day changes don't mean much. So checking it daily is only going to make you crazy. Truth be told, checking it once a month is going to be plenty. So if you've done your homework, chances are your investment will pay off nicely in the long run. But what if it doesn't? How do you know when to jump ship? When looking at the performance of your investment, you'll want to look at the total dollar value of your investment, not the share value, and compare that with the total amount you paid in the beginning. Okay, so there are 2 reasons why you'd want to get out. 1, if your fees get jacked up more than you think is reasonable, or 2, your fund underperforms its peers more than 2 years in a row. We'll talk more about that in another video. I think this is enough for you to chew on and digest for now. Got it? I think you're going to go do great.